Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. QT, or the quantitative tightening, and its implications on financial markets and the economy is back as the key point of discussion amongst investors and other market participants. Firstly, what is quantitative tightening? Well, we need to start with the question of what quantitative easing is. Quantitative easing, or QE, is an unconventional expansionary monetary policy that central banks have in recent times turned to once they've reduced their own policy interest rate to or close to zero. In the process of QE, the central bank creates money electronically and uses it to buy assets, usually government bonds, from the market. This increases the amount of money in the financial system, which encourages banks to lend more and push interest rates lower. This in turn should encourage businesses and households to borrow. If businesses use the money to invest and consumers spend more, this can give the economy a boost. Now, let's turn to our primary question: what is quantitative tightening? Quantitative tightening, or QT, is a contractionary monetary policy that is the reverse of QE. The government bonds and other assets that central banks have bought from the market through the QE program are held on their balance sheets, massively increasing their size. QT is the process by which central banks reduce these holdings. QT could occur passively or actively. Passive tightening is when the central bank allows the bonds on its balance sheets to mature rather than replacing them. An active QT is one in which the central bank outright sells its holdings back in the market. Now, let's look at the current episode. To help the economy during the pandemic, the US Federal Reserve unleashed a massive QE program which saw almost doubling its balance sheet to $9 trillion. This was, of course, in addition to bringing its policy rate close to zero. However, as the economy recovered and inflation picked up, the Fed started to normalize its policies, both conventional and unconventional. Along with raising its policy rates, the Fed has been unloading some of the Treasury and mortgage-backed securities it holds since June at a pace of $47.5 billion per month. As per the plan, starting September, the pace of quantitative tightening is set to double to $95 billion per month. This change in the pace of QT is being once again discussed in the markets. The concern market participants have is, if the QE has helped the economy stabilize during the pandemic and helped financial and monetary conditions to improve, QT, the reverse of QE, is likely to destabilize economic growth and worsen financial and monetary conditions. While this concern is valid on the surface, it lacks historical evidence and complete understanding of the semantics. In the first place, the impact of QE on financial markets is not well established. Of course, there has been a strong positive correlation between the size of the central bank balance sheets and performance of risk assets, but correlation is not causation. The numerous studies that have attempted to quantify the actual impact of QE on the economy and financial markets have pointed in different directions. Similarly, there is no agreement amongst think tanks, market participants, and academics on how QT will impact economic growth and financial markets. A remarkably simple question like, what will a $1 trillion worth of quantitative tightening equate to in terms of rate hikes, has no consensual answer, where the responses range from 25 basis points to 125 basis points. This makes us believe that the impact of QE and QT is not well understood by the market. There are several reasons for this. The most important is lack of sufficient precedents for the global economy. Also, other things include the number of parties involved in the circulation of money and instruments during these unconventional policies. Each of those parties, which include governments, central banks, investors, households, businesses, etc., have their own assessments in putting these cash flows to use. Moreover, QT is not the same across the regions. For instance, the impact of QT might be much more pronounced in the Eurozone than in the US, as the former is more cash-based economy than the latter. In a nutshell, While QT is well underway, the impact that this unconventional contractionary monetary policy has on the economy and financial markets is not well understood. Therefore, investors need to keep this in mind when reading news headlines regarding QT and while making investment decisions based on the same. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on what was discussed on this podcast, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com for more information. You were listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.